Are looking for a mobile wallet to hold and access your crypto assets, you need to go to argent.xyz and download the Argent smart contract wallet onto your Android or iOS device. Argent is one of the most secure ways to hold your crypto assets on your mobile device while still being able to access all the DeFi products and services that we know and love. Argent has enabled one-tap access to all the DeFi applications that we all use the most, and recently onboarded into the Argent app is the Yearn vaults. You can now access yield from a specific vault from Yearn, and then Yearn handles the rest. Also new to Argent is Balancer and being able to supply liquidity to Balancer pools and also receive BAL rewards for doing so, all from your Argent wallet. One of Argent's newest features is the ability to route trades and swaps through the various liquidity pools in the ecosystem, ensuring that you always receive the best rates when you trade inside of Argent. Argent has done a ton of effort into making sure that your assets are as safe as possible. They have social recovery options with their Guardians feature, making sure that any trusted friend or family member can restore your access back to your Argent wallet if you were to ever lose or break your phone. And there's also some simple account features such as sending limits and whitelisted accounts, making sure that your money doesn't ever do anything that you don't explicitly approve. In order to see the Argent wallet in action, go to argent.link/bankless and download the app. We're also brought to you by Monolith. Monolith is your cool new DeFi account, your DeFi savings account, your DeFi checking account. Except the cool thing about the Monolith DeFi account is that it gets software updates, right? You actually get to increase the usefulness of this over time. So here are some of the features. Monolith is a smart contract wallet with a lot of the features that you would expect if you've come to know DeFi and what it is. You can add money to it. You can put that money to work in Compound and accessing yield. But you can also swap through Uniswap. What was cool with Monolith is that they will send you a very sexy Monolith Visa card that connects to your Monolith smart contract wallet on Ethereum. So it's a really awesome tool to live a bankless life with a savings account that gets software updates. So this is something that you're never going to find out in the real world, but you can still do real world things with, real money, like buy your groceries. So that's just fantastic. Coming soon to Monolith, actually already here to Monolith, is now you can buy DAI and get it sent to your wallet directly, right? So it's also being an on-ramp. So you don't have to go through your centralized exchange like Coinbase or Gemini or wherever. You can just go straight from your bank account right into your Monolith checking account smart contract wallet. So check them out at monolith.xyz. So Vitalik, the conversation about proof of work versus proof of stake was really, really big from what I can remember in 2017 and in 2018, or it was probably even bigger before that, but I came into the world of crypto in 2017. And I actually think it's really valuable that people understand this debate and why, and understand the merits of proof of work and also understand the merits of proof of stake in order to understand, like, why is Ethereum so committed to proof of stake? Like, why do we want this? And so you wrote this article on your blog, Vitalik.ca, everyone should check it out, called Why Proof of Stake. And we kind of want to go through some of these points so we can help the Bankless Nation like kind of come to understand the terms that you use here and the arguments of why proof of stake is inherently the right, I'm not going to say superior, but the right consensus mechanism for Ethereum. Right, because many Bitcoiners will still say to this day that proof of work is the one true consensus mechanism. So let's go through some of the points that you wrote here. Proof of stake offers more security for the same cost. Like, what does that mean, and how does staking offer that?
So the basic idea here is that if you try to quantify security, so the easiest way to quantify security is just how many dollars do you need to spend to break the thing. Then if you look at the ratio of security to cost, where cost just means like how many rewards you have to push out to the participants, then the ratio of the security level to the amount you pay for the security just is much more favorable on the proof of stake side than it is for any version of proof of work. And I think the way that you can look at this, right, is that if you look at just, first of all, start off with a comparison between GPU-based proof of work and ASIC-based proof of work. So this is a comparison that even Bitcoin people make all the time, right, when they defend why their ASIC-based proof of work is better than the ASIC-resistant algorithms. Is basically that in the GPU case, the cost of mining is only operating costs, and there's basically no capital cost, right? Because like you can rent GPUs. If you buy a GPU, you can always sell it after, even if the blockchain disappears, GPUs continue to be useful. And so if you want to attack a GPU-based chain, all you have to do is just rent some GPUs for 6 hours or however long you want to do an attack. And so the cost of an attack is basically going to be just exactly the same as the cost of the rewards during the time period that you're attacking. And if you as an attacker receive block rewards, then the cost of the attack even drops to 0 or it becomes profitable all by itself, right? So for GPUs, like while GPU proof of work mining has a big advantage in terms of being decentralized, from a security perspective, it actually is quite weak. And we've seen this, right? As I mentioned, Ethereum Classic has been getting a lot of 51% attacks recently. Now, if we look at ASIC-based proof of work, ASIC-based proof of work is considerably more secure because ASIC-based proof of work has not only ongoing costs, but also capital costs, right? And an analysis I did a few years ago suggests that it's about 1/3 ongoing costs and about 2/3 capital costs. Maybe that ratio changes over time. I actually have no idea which direction it's going to change into, but like that's roughly what it is approximately, right? And if you kind of make some assumptions about how long an ASIC lasts, you can actually kind of reverse engineer what the capital costs are, kind of from the amount of money that you're paying for rewards, right? So the idea basically is that if your chain is paying $1 a day in rewards, then out of that $1, 1/3 will be operating costs, 2/3 will be capital costs. And you can think of the 2/3 that's capital costs as being a kind of amortized over the entire period of time during which that miner is mining, right? And so if you assume that an ASIC lasts about 2 years, I think now it's a little bit more. It's a little bit more than 2 years, but Moore's law, increasing efficiency, wear and tear, all of these things. So at the 2-year level, right, all you have to do is you basically take the amount per day that they're spending on the ASIC and then multiply that by the number of days in 2 years, and that's the cost of the ASIC, right? And so if your model of an attack is that an attacker just has to buy up as many ASICs as the legitimate network, then you can use this to kind of get an estimate for the cost of the ASICs needed to attack the network. And so here you get about $486, and so that's the cost of breaking proof of work if you have ASICs, right? So already much better than GPUs, but ASICs have a cost of centralization. So now if we go to proof of stake. So proof of stake,
can I get you to comment on Ethereum 1? Would you, if Ethereum 1, if that was the chain that would just carry on into the future forever, would you have been in favor of it being GPU based, or would you have been interested in making an ASIC version of Ethereum?
So at the beginning, I was definitely much more pro GPUs, but I think more recently, it's not so much that I've become more pro ASIC; it's that I've become less pro GPU, and so it's just like it just feels like a kind of a tragic choice between two differently bad options, to be honest.
Okay.
But GPUs did have this nice property in the early days that it was a much more egalitarian, decentralized way to distribute the tokens, which arguably that's kind of what Ethereum was looking for in like the first part of its life.
Yeah, I agree. And I think that's very important. And I think Ethereum is definitely better as a result of having that GPU mining for the first few years of its existence.
As somebody who came into Ethereum because it was able to be GPU mined, I have to say thank you for making that choice.
But not as secure compared to ASICs is the point, at least from an economic security perspective.
Yeah. And the thing to keep in mind, right, is that the longer I think the chain even manages to be a GPU mined up until this day only because people realize that proof of stake is coming, right? Like, if you just basically the reason why there isn't much more work on building ASICs is that people realize that any ASICs that get built will only survive either a year or potentially even a few months. Like potentially in response to the chain getting taken over by ASICs, we could even just rush the entire transition and just do the merge in a couple of weeks, right? Doing that sort of thing would totally be extremely disruptive to the Ethereum ecosystem, but doing something extremely disruptive in response to an already extremely disruptive attack is the sort of thing that would happen, right? And so like people, I think, realize that it's just too risky to build ASICs because like there's just no guarantee that you're actually going to have enough of a period of time during which you're going to be profitable, and that's why the chain continues to be GPU friendly, right? And so the fact that like this GPU friendliness has been possible to this day should not at all be taken as evidence that GPU friendliness is a stable equilibrium going into the long term.
Right, makes sense. Shall we get into proof of stake?
So yeah, so proof of stake. So basically, the way that I view proof of stake is I view proof of stake as combining the efficiencies of or this capital cost property of ASICs, but really cranking that property up to the extreme, and at the same time having the kind of open accessibility of GPUs, right? So basically, proof of stake is almost entirely capital costs, right? The cost of like operating a node is fairly small, and the difference is, though, is that in the case of ASICs, the capital cost is only kind of amortized over the course of, about 2 years. So it's about like 50% a year. But unlike ASICs, deposited coins do not depreciate. Deposited coins, you can deposit them, you can stake for a bit, and you can get them back. And so you actually don't even need that high of a rate of return to motivate people to stake. So here I was actually, I think, understating the case, right? Because like here I was saying, oh, imagine a 15% rate of return is enough to motivate people to be willing to lock up their money and stake. And I think 15% is roughly the rate of return that we're going to see in this kind of initial phase of ETH2. Like I think with the current level of deposits, it's about 18%. But we're going to see more deposits, but I think in the long run, especially when it's possible to just deposit, stake for a bit, and then withdraw and get your money back within a day, like I fully expect that the rate of return will just drop to something closer to 10% or even 5%. And so, but even with 15% a 15% rate of return on capital, that basically means that $1 per day of rewards is going to attract 6.667 worth of deposits, right? Or basically, like if you have if you stick $2,400 in as a deposit, then your annual return would be $2,400 multiplied by 15%, which would be around close to 365. And so $365 a year is equal to $1 a day, right? So if we assume 15% rate of return per year, then every $1 a day in rewards is going to correspond to $2,433 of deposits. That's at current rates. If the rates drop to 5%, then this number obviously goes up to 7,500, right? Now, if we assume that only 90% of the costs are capital costs and there's still 10% that are operating costs, then the 2433 goes down to about 2189. But basically, even still, right, we have 5 times more deposits that are paid for by the same rewards in proof of stake as compared to ASIC-driven proof of work. And this is now in the long term, like I expect it to go up to something like 10,000. So it'll be 25 times stronger than proof of work.
So does the security, is that summarized as the security of proof of stake comes from the fact that Ether, the asset, doesn't deprecate in the same way that ASIC, a machine, does? And so Ether gives you a year-on-year return, where an ASIC gives you a year-on-year depreciation, devaluation of the unit, right? And so that's the fundamental component of where proof of stake gets its security from.
Yes, that's definitely an excellent way of stating the point.
Cool.
All right, so where we've come so far is we have GPU based proof of work, which Ethereum is on now. That means you can use a GPU card in like your NVIDIA like gaming machine to mine a little bit. And that total cost of attack is like fairly cheap. Like you can attack that fairly easily, lower economic security. And then Bitcoin has ASIC-based proof of work, which is a bit more expensive to attack, so higher economic security.
And that economic security comes from the fact that the ASIC is only doing one job. That's only possible to do one job, which is mine Bitcoin. It's dedicated.
So it's all sunk capital costs, basically.
Yes, you are locked in.
So, and now proof of stake, because it's like ultra sunk costs, that's the only thing you can really like kind of, do with it. It's almost like a tokenized ASIC on steroids, if you will. That's even more efficient. And how would you quantify this? Is this like a 5x more efficient Like bang for the security for the dollar, or is it a 10x?
Like according to the kind of back of the envelope numbers here, it's 5x in the short term and up to 20x in the long term.
Wow. So I think of this, Dave and I have, often sort of analogized these sort of chains to nation states, and almost this is like the security force. This is the defense, right? And so it's almost like you're upgrading your military from cavalry and horses to like Panzer tanks here, right?
Like trying to think like what's a good analogy. Like, okay, so here's a really fun and dumb analogy. So GPU-based proof of work is you have to like basically hire soldiers out every day to patrol your borders to make sure the enemy army doesn't get in, and you have to keep on paying them. ASIC-based proof of work is the Great Wall of China. Then proof of stake is, imagine a Great Wall of China that has the property that the way that this wall is constructed is that when people are not staying in their own houses, they just teleport the walls of their houses, and they make it part of the Great Wall of China. So whenever you're not in your house, whenever you're like going off on vacation, you just click a button and your house teleports to being part of the wall. And the government pays you some small amount of money to do this, and you're happy to collect the reward. And then as soon as you want to move back into your house, you just click a button again, and the walls teleport back, and they're part of your house again, right? So basically, it just like you don't even need to kind of create these separate resources. You're just kind of taking advantage of existing resources, and you're moving them over to a different purpose when people know that they don't need them for a long time. So much more capital efficient.
So the idea is that the Great Wall, this version of the Great Wall of China, would theoretically be a lot higher because of the incentive for everyone to allocate the walls of their house into the walls of the Great Wall of China in the moments that they are not inside their house, using their house as a house.
Exactly.
The interesting thing, so is I think here, so you talked about this in the article, right? So we're talking about a 5 to 20x gain in proof of stake potentially. And the question is, what do we do with this efficiency gain as a social contract for Ethereum? Can you talk about that? Because it seems like there are like, maybe two options here of what to do with this drastically improved military, drastically improved Great Wall.
Yes. So one of them is to keep the military budget the same, but have much higher security. And the other one is to have the same security, but cut the military budget down. And I guess the reason why I think we're taking the second approach is actually best to kind of even described in the next section, right? Like, I think Ethereum has enough security today, especially if attacks become much easier to recover from. And we actually don't even need to have like too much spending going into keeping the wall up, because if it turns out that basically even if someone successfully invades, so like you can do this clever move where you just like hard fork and you delete their army. So
that I want to get into that just to link folks into what you're talking about. Like, so the way Ethereum right now and the way Bitcoin right now pays for their military is generally through block reward, through issuance, through supply, right? So, and Bitcoin's approach is to cut that military budget, at least military budget denominated in Bitcoin, every 4 years, cut it in half every 4 years. So we're the Bitcoin protocol government every 4 years. You know what? It's forced on you. We're going to slash your military like by 4. Right? At least denominated in Bitcoin by two, excuse me. Ethereum's approach is basically to do something that's maybe more what the social contract is kind of called minimum necessary issuance or minimum viable issuance, where it's like, hey, like maybe we can drop this a whole lot more because we have a stronger defense system. And so that issuance essentially is what goes to pay for the military, and maybe that could be slashed, maybe that could be cut. Right now it's at 4.5% or so, and we could go to something less than 1%.
Absolutely. Yeah.
Vitalik, one of the theories I've had about one of the reasons why proof of stake is more secure in the long term is that with that reduced issuance, that reduction of issuance actually compounds as a benefit over time. And I want to get your take on this because I don't know if this is real or not. And this is the same dynamic is present in EIP 1559. The more ether that's burned in EIP 1559, the more ether is unable to be leveraged in an attack against stakers, right? The less ether we can make available to the secondary market, the less ether there's available for attackers to be able to grab and use that to attack the Ethereum network. Is that a real thing? So like the less ether that we issue, is that over time adding to security?
That's definitely an interesting and kind of novel way to think about it. And I guess, generally, yes, like the less ether there is, and even like the higher the price goes, the harder it is for an attacker to buy enough to successfully make an attack. And that's definitely one of the factors that contributes to security. And if you have miners that are just constantly selling millions of coins every year, then some of those coins are going to end up in the hands of people that might be interested in attacking it at some point.
If you want to live a bankless life, you need to get a hardware wallet. There is no alternative for storing your crypto in a self-sovereign fashion. That's why I have 4 ledgers that I use to manage my different crypto assets using the Ledger Live account as well. Ledger Live is like your home base for managing your Ethereum, DeFi, and crypto accounts. It does a really good job of aggregating all of your different Ethereum wallets if you are the type of person that uses more than one. But you can also add other cryptocurrencies like Bitcoin or Cosmos or whatever your preferred blockchain is. And then it will display an aggregate portfolio of all your accounts at the main page. One thing that Ledger is doing a really good job of is enabling all of the money verbs that me and Ryan talk about with the Bankless Skill Cube enabled in the Ledger Live app. So right now in the Ledger Live app, you can buy, sell, lend, swap, and stake your crypto assets, which is doing a really good job of fulfilling all of the money verbs in the Bankless Skill Cube. Something that's new to Ledger Live is Ledger Swap, where you can swap assets one for another directly inside the Ledger Live application, ensuring trustlessness in your financial activity on Ethereum and on Bitcoin. If you want to learn more about what you can do with a ledger, go to the blog post, The Power of Ledger Live on the Ledger website, where they share some of the more advanced things that you can do with your ledger that you might not have known about. There's a link in the show notes that will take you to the Ledger shop where you can get your preferred Ledger hardware wallet. I personally like the Ledger Nano X, but I also have both. They're both great options. When you own a ledger, you own your own assets in the way that they have been designed to be held by the user and the user alone. So go get your ledger today to make sure that you are as self-sovereign as possible. The Bankless State of the Nations are brought to you by Yearn. Yearn is DeFi's first self-building community-run project, which I just get really, really excited about. Yearn is a system that seeks out yield in DeFi, and it does that in a number of different ways. A very aggressive way is with the vaults, where you can deposit your preferred asset of choice, and different DeFi experts will come in and generate a strategy for what to do with your deposited token, right? And so it'll go find ways to get yield in that deposited token in DeFi. For those who want to just earn yield on their stablecoins, the Yearn system is for you, where you can deposit your preferred stablecoin and Yearn will go and figure out which money market on DeFi in DeFi is producing the best interest rate, whether it's DYDX, it's Compound, or Aave. It looks around DeFi to see where the yield is coming from, and it directs stablecoins automatically so you don't have to. Check them out at yearn.finance to get started, and also check out the stats page to see what other people are doing as well. So let's go into one of the grand ways that say somebody did somehow manage to get their hands on enough ether to attack the chain. We actually have a way around this. And so one of the sections in this piece is titled Attacks Are Much Easier to Recover From in Proof of Stake. Maybe we can talk about like after an attack happens, what paths to maintaining or restoring security does Ethereum have?
Yeah, so I think in the GPU case, the only defense is basically just waiting and hoping the attacker goes away, which has worked so far, right? But like as soon as an attacker comes that's persistent, you're basically screwed and you have to try to figure out something else. in an ASIC-based system, you do have one form of defense, which is you just change the proof of work algorithm, and what that does is it basically kind of bricks like all the ASICs. It renders them useless, but it bricks both the attacker's ASICs and the honest miner's ASICs, right? But if the attacker is willing to suffer that initial expense, then at that point it just turns into a GPU mined coin up until after a couple of years where people build ASICs for the new algorithm again, and so it just turns into into the first paragraph, and the attacker can just continue the attack really cheaply for as long as they want. And in fact, I would even argue that it's worse than this, because if an attacker starts doing this, and if the attacker commits to continuing to attack, then it actually takes away from the incentive to build ASICs for the new algorithm, because anyone building the ASICs knows that if the attacker is going to continue, then potentially those ASICs could get bricked a second time. So like basically the fact that bricking hurts both the attacker and honest miners actually like really makes the game theory behind all of this even worse. So in the proof of stake case, basically it gets much better, right? Because like we have this concept of slashing, right? So if you contribute to breaking the chain, you get slashed. And even if you contribute to breaking the chain as part of a 51% attack, you get slashed. Now, there are attacks that are hard to detect and hard to slash for. So a big one is like a 51% coalition censoring everyone else. But you can get around this by using this wonderful trick that the Bitcoin people invented in 2017 called the UASF, the user activated soft fork, right? Basically just users coordinate on participating in a minority chain, and they just abandon the majority chain that's censoring them. And actually, because of the way that the Casper FFG rules work, the attacker cannot legally kind of move over to the minority chain without contradicting themselves and getting slashed. And so the attacker just gets leaked, and they lose about half their coins, right? So basically, no matter how you attack the chain, it's going to be very expensive for the attacker, not very expensive for everyone who is not an attacker. And so the game is very asymmetric, right? Like every time the attacker attacks, they lose a huge amount of money, and potentially like the amount of coins that are burned as a result of an attack could even mean that an attack would cause the price of ETH to go up.
So like one of my favorite features about proof of stake is that if an attacker attacks Ethereum, it makes all of the stakers rich by default. Well, not by default, but yes, it's highly likely that the price of Ether goes up because of somebody's buying up all this Ether. One question I had about this, like using this as a defensive mechanism in proof of stake, this is relying on the social layer, right? This is in this moment, security has migrated away from the actual code and moved into the social layer, which it perhaps is one day, if this ever does happen, it would be coordinated via something like Twitter or Reddit. Can you talk about that dynamic?
There's definitely a lot of kind of discomfort in relying on the social layer for consensus. But I mean, actually, I wrote about this quite a bit in my original 2014 article, the one where called like "How I Learned to Love Weak Subjectivity." If you actually even just go in and Google for that now, you can probably find it. Here, I'll just wait for you to. There we go. Down. It's there.
You visited.
No,
right?
I've read this one
twice. Yeah. So if you just like scroll down like 10 paragraphs, just keep scrolling until I tell you to stop. Right. This is keep going. Keep consequences. Okay. Go down to the paragraph that says this ignores. I think it's the third one. However, this logic ignores. There we go. So basically, the argument that I make is that relying on social consensus is actually reasonable occasionally. It's just that social consensus is not something that you want to kind of keep leaning on forever, right? So the idea is basically that even Bitcoin relies on social consensus to some extent, right? Like even the UASF that was proposed in 2016 was ultimately a form of social consensus overriding mining. So basically, hard forks are done with social consensus. Even the idea that if miners push a blockchain that would increase the supply to beyond 21 million, then people would reject that blockchain as like is ultimately secured by social consensus. The difference between a malicious protocol change and a bug fix is social consensus. So relying on social consensus in these kind of extreme matters where and especially on matters where there's clearly one side which is an attack and one side which is just trying to push the chain forward is, I think, actually a reasonable thing to do. The thing that you don't want to do is you don't want to rely on social consensus too often, right? Mm-hmm. And the thing to keep in mind is that if you even think about like how an attack on proof of work would be responded to, right? Like even like defenders of ASIC-based proof of work will say, oh, if our 51% attack happens, we can just break the ASIC and we can change the algorithm, right? Like if you press them on it, they will say that this is a defense. But that defense as well, it's also a social consensus. Like changing the proof of work algorithm is also a form of social consensus overriding the code. So
it's also striking that the price of Bitcoin, the price in itself, is one layer of social consensus too.
It is indeed, yeah.
And we've seen this the idea of bricking ASICs that's played out a number of times, I believe, in the Monero community. So this is not hypothetical conversations. This is strategy that blockchain ecosystems have leveraged.
Exactly.
So let's move on to one of my favorite subjects, which is how proof of stake is more decentralized than ASICs. Some people would call this a bold claim. Vitalik, why can you make such a claim?
And I think we do need to break up proof of work into two categories: GPUs and ASICs. There is a very decent case that GPU-based proof of work is quite decentralized, and I'm happy to admit this. Like my qualm against the GPU mining is not about the decentralization; it's about the security, right? Now, the problem with ASICs, on the other hand, is that in order to make an ASIC, you need millions of dollars of capital, right? Now, you could say, oh, you don't have to make your own ASIC, you could buy an ASIC, but the reality is that if you're buying an ASIC, the side that's making the most profit is not going to be you, it's going to be the ASIC manufacturer, right?
People selling the shovels.
Exactly. Like in the long run, it's like the game is very much one that's kind of skewed to benefit whoever can sell the best shovel. And, whoever can sell the best shovel has a lot of, they can potentially even sneak in code that could allow that ASIC to be bricked remotely. Like they could do all sorts of really evil things that are harder to do with if you're running the thing on general purpose hardware. So basically, ASIC-based mining really does rely very heavily on this very small number of these very wealthy and kind of powerful manufacturers. And so, basically, if proof of stake means the rich gets richer, well, guess what? ASIC mining also means the rich get richer, except the bar that you need to pass in order to get richer, in the case of ASIC mining, is something like $10 million. But in the case of proof of stake, it's $20,000 today and much less than $20,000 in the future when staking pools become possible.
So I've been chewing around the ideas of staking pools, and there's a bunch of different design parameters. But I think the staking pool that retains as much ethos of Ethereum as possible, which I think that there is a spectrum of how much does a protocol or company on Ethereum retain the original ethos of the system. There's something to be said for that. And that's kind of where I turn my attention to Rocket Pool, where Rocket Pool's trying to become a staking pool for people to decentralize the amount of people that can participate in staking by being a pool, and then also decentralizing the nodes by making more total nodes available to be part of the Ethereum proof of stake consensus mechanism. When you think of Rocket Pool, is that what you think of?
Yeah, no, I think Rocket Pool is definitely one of the good examples of someone trying to do a good job. The ETH2 protocol is really explicitly designed to make decentralized staking with things like multi-party computation as easy as possible. So that's definitely the sort of direction that we're looking into.
There's also this sub-argument that you made here, Vitalik, that proof of stake is more censorship resistant. And that's basically because it's not on the electricity grid, right? For instance, like in the way that a GPU mining or ASIC mining footprint might be. Is that the main argument here?
Yes, exactly. Like if you imagine, you know, you're living in, say, Venezuela, and you want to participate in the Ethereum network, then if you're a proof of work miner, then, you know, realistically, you're consuming huge amounts of electricity. You have to get huge amounts of hardware. If the government wants to find you, they can find you, right? Like it's not hard to see someone consuming that much electricity. Like these are techniques that they've already perfected for years to figuring out, like finding people who are growing the wrong kind of plants in their backyard, or you know, this is fairly established stuff.
It does make you wonder how long it would take a motivated government body like the United States or some other government body, maybe let's not name different governments here, to go seek out all of the major Bitcoin mining, or even Ethereum mining facilities in the world and just confiscate them, take them over by physical force.
These are ours now.
Yes, it's just I think it's kind of a little bit of a game, maybe that some in crypto play, as if we've already faced off against these nation states that are actually trying to censor us. The reality is they're just not even trying yet. So yeah, that is an advantage that may come into play. But there are also some advantages that you talked about here, Vitalik, of proof of work. And I think we'd be remiss if we didn't mention the ways proof of work actually is superior, because there are some trade-offs. Can you talk about these?
Yeah, so I mean, these are like what I think are the two best arguments in favor of proof of work. Like one is this critique that proof of stake feels more like a closed system. Like there isn't this kind of new source of issuance that kind of brings fresh economic blood into the ecosystem. And so, it feels like the system has this kind of naturally kind of entropic pressure to just be more of the same people by default. And this is definitely something that does kind of concern me to some extent. And the best rebuttal that I have is that in proof of stake, the rewards in general are going to be fairly low, right? Like, I think if proof of stake rewards were, say, 10% of like annually, then like I could see that very quickly lead to a few stakers very quickly having a very large portion of the entire supply and just dominating everything. But here we're talking about validator rewards equal to like up to 0.5 to 2%, probably closer to 0.5% of the total ETH supply. And the more validators are staking, the lower the interest rates get, right? And so the amount of time needed for this factor to like cause a large amount of concentration is huge, right? It's potentially over a century. And on such time scales, like, does it really matter much, right? Like people want to spend money, they want to distribute their money among their children, they would want to give their money to charity. And so like basically if there are any natural economic pressures toward deconcentration at all, then like they're going to have an effect that's larger than 0.5% every year is basically the argument. Whereas if that rate was, instead of 0.5%, something like 4.5%, then I mean, I think this argument would actually have a much stronger case. So this is one of the reasons why I'm pushing for lower rewards.
And the reason people make this argument is, of course, is as we stated earlier, staked ETH is almost like an everlasting ASIC. There's no depreciation. There's no capital depreciation, unlike a real world
unit doesn't
physical ASIC.
deprecate.
Exactly.
Yes, exactly.
And notably, the people that crypto has like accidentally, inadvertently made really wealthy are largely people that I'm guessing, this is my gut take, that weren't wealthy beforehand, right? And so like, what's the point of hanging on to you every single last denomination of Ether if you can't sell it and like have like kind of a nice, more comfortable lifestyle? Like the people that have large supplies of Ether are going to have to sell if they ever want that material impact to do something real in their lives. And so that's kind of what I think what you were alluding to, Vitalik, is that the rewards, the passive income rewards to Ether accrue slower than people's people find ways to sell their ether to buy a new house or new car or something. And so there's like this natural sort of like incentive to let go of your ether. Cool.
Yeah.
But what about the second point, Vitalik? We talked about weak subjectivity earlier. Does anything bear repeating here?
Now, weak subjectivity is this extremely fascinating topic, and I think it's been really the center of the debate almost ever since the beginning and up until this day. Like basically, weak subjectivity is this really subtle thing where like the idea is that in proof of work, you have this property that you have your client and you can just start it at any time. And even if you've been offline for 10 years, you can just start it up and you can sync to the valid chain and you have all, or the canonical chain, and you have all of these economic guarantees. In proof of stake, like you can kind of still do that, but it depends on what guarantees you want, right? So like if the guarantees that you care about are in an honest majority model, so you just assume that the majority of people are nice, then you can still do that. But if you want to have a hard economic guarantee, so you want to have a guarantee that says, tricking you requires the attacker to burn a huge amount of money, the way that proof of stake kind of promises strong economic guarantees, then you lose this property to some extent, right? And the reason why you lose this property to some extent is basically because if an attacker just who has say 51% of the stake creates a fake chain and they convince you that this fake chain is the real chain, then like normally the way that they will get punished for this is it would be slashed, right? Like if you create a fake chain that conflicts with the real chain that you already contributed to making, then some large portion of the validators would dissect. You can make proofs and you can publish those proofs into both chains, and you can burn the attacker's money. This is just like standard, proof of stake theory, like how slashing works. But the problem is, what if the attacker has already withdrawn their the deposits that they used to make the attack by the time that they actually need to do the attack, right? So what if someone has been offline for a year, and you feed them a chain that looks like a valid chain from the perspective of their client that was online for the last time a year ago, but back in present day reality, you've already taken out all your coins, and so whatever slashing happens can't actually hit you, right? So you could still trick them, and you would not get slashed for it. And so if you want to be resistant against this attack, basically you just have to log on and kind of be online often enough that basically the time difference between any two times during which you come online is less than the time that it takes for like something like 1/3 of the validator set to be replaced, right? Which is, and that number depends on the size of the validator set. It's like somewhere between a couple of days and a couple of months, depending on how many people are participating. So like that requirement, the requirement that in order to have a really kind of economically guaranteed level of security on which chain you're getting, you need to log on with your client at least once every few months. Like that is this weak subjectivity requirement. And the reason why like a lot of people feel uncomfortable about this is because it basically means that like if you're just joining the system for the first time, then you for the first time that you log on, you need to basically find some third-party source that basically tells you like which chain is the canonical one that you should be following. Now, most of the time, this actually isn't a big deal because most of the time there aren't going to be 51% attackers trying to use their old keys to screw people over, and so there is really going to be like one chain that has enough signatures, right? But in the extreme case where there are attackers that can like buy up people's old keys, then basically, in order to disambiguate, you do need to find someone to trust to give you that information. And fans of proof of work say that, oh my God, this is trust, this is fatal. What are you doing? You've completely destroyed the point of cryptocurrency. But my argument is basically that like this level of trust is a level of trust that we already have. So like, for example, you already trust developers to tell you the most recent hard fork version. You already trust them to fix bugs. You already get software updates from them once every half a year or so. And so why not just like leverage that existing level of trust and like use it for proof of stake checkpointing as well. And
So
that's basically the
So with proof of work and Nakamoto consensus, we have the ability to actually legitimately and concretely verify the amount of work that is done on a particular chain. We don't have that with
Yes.
proof of stake because we're not doing work. We are, and so there.
Right. We're verifying signatures that are signed by validators. And in order to recognize that those validators actually are real, you have to look at the state of the blockchain itself, like at the time, a month ago to a year ago, right? So the security of a proof of stake chain is definitely more kind of, I mean, it's not circular, it's more like a spiral, right? It's like the security of the system today depends on the validity of the chain 6 months ago, and the security of the chain 6 months ago depends on the validity of what happened 12 months ago. And so like if you skip one of those steps, then and if you're offline for longer than that period of time, then you do need some way to kind of help you disambiguate and come back online. But if you're there more often, then like basically staying in sync with the chain is more of this like necessarily dynamic process.
Right.
So here's kind of, I guess, my takeaway to just sort of summarize this article, and you guys jump in if you have some other things. If you are willing to get past this edge case weak subjectivity requirement, and you made some compelling arguments why that makes sense, or it's less important than others think. And if you're willing to get past this issue that stake never depreciates, and so there's the capability for people in the system to continue accruing wealth, and you sort of mitigate against that with lower rewards overall, then what you end up with is a chain that is much more economically secure and also more efficient in that economic security. So you can do things like reduced issuance, reduce the cost to actually secure that network. Essentially,
more
you get
security per dollar.
Exactly. That's what proof of stake. That's what proof of stake provides, at least under Ethereum, right? Because there are other flavors of proof of stake. But
yes.
Would you add anything to that, Vitalik?
No, and I think in general that's a great summary.